What's up, everyone? I'm back here again looking at another stock that I might add to my portfolio. Maybe, maybe not. It's the first time I'm looking at this stock. So, what stock is that going to be? Well, before I go into that, like and subscribe to my video. It really helps with the algorithm. And I need to go into my requirements for my stock. So, the requirement for my stock, it needs to pay a dividend because it's going into my dividend portfolio. Only makes sense if it goes to a dividend portfolio. It has to pay dividend. Number two, it has to be good financially standing where, hey, it's not in a negative. And number three, it has to have good growth opportunity. Now, that said, what stock am I going to be talking about?
For passive income. Passive income looks like this. You take money that you can afford to go to zero and you put them into two places that have historically created passive income. Public markets that you don't care if it goes up and down and you just wait to the end, or real estate. And you hope that your real estate area doesn't get crushed. Everything else almost doesn't exist.
NextEra energy is power the future ahead of what was next. So 100 years of powering progress. So let's see what they do there. It looks like they're in Florida. They invest in energy. So they're 55% renewable, 36% natural gas, 8% nuclear, and 1% other. So it looks like this is a renewable energy company, which, to be honest, it might be a really good thing. Well, before I get into the business, I basically know that the simple term, it's an energy company.
Next era of American energy is here. NextEra Energy Resources is an American-owned company and the world's leading generator of renewable energy from the wind and the sun.
Why would I want to add an energy company to my portfolio? Well, you need to have a diversified portfolio. You can't be in all tech. You can't be in all commodities. You can't be in all real estate if you want to build a proper portfolio. Now, some people don't care about that, but I want a very diverse portfolio so it can withstand all market. Now, let's go into NextEra Energy Inc. Ticker symbol NEE. So
Wall Street and investors today in your conference call. I thought this was fascinating that you and Florida Power and Light, sort of the current company with the former name that you guys have, is not just the biggest renewables generator in America. You also have the largest natural gas fleet in America, and you may restart a nuclear plant in Iowa.
The 1 month, it's down 0.01%. 3 years is up 0.92%. Year to date is 0.22%. 1 year is negative 1.76. 3 years is negative 8.32%. And 5 years is 18.13%. Now, it does not look like it has a good growth, but we need to look at the finance to see why. Maybe it's just, bad news, but that's not the bad part. It might be having a turnaround point, but let's see. But before we go into the finance, I like to go to another website to compare the dividend yield. So the dividend yield is 3.17%. So the annual dividend pays $2.27. And it pays out quarterly. So it does pay dividend. It has a dividend growth of a 10.08. Pretty good, and 29 years of dividend growth. So looking at the history of dividend, it pays pretty good dividend. Now, if we add this 3.17%, it has a 3.17% growth if it stays stable. Now, next I'm going to look at the finance, and I really like to use MSN for finances because if you ever need to know what something is, you just go over here and it tells you. So, growth year over year. Investment grow by how fast company revenue sales growing year over year. So it tells me how good the income is doing year over year. Has they been selling more? Have they not? So 17 billion, 16 billion, 19 billion, 18 billion, 17 billion, 20 billion, 28 billion, 24 billion. Yeah, that's not, it's growing, but I'm not sure why it has these dips every other year. Now, let's see. Operation expense or income is 30.21. That's how much it costs to operate. Now, I don't know why they don't have a gross margin, but hey, let's see what the net profit is. They're at a pretty good net profit, 23% net profit. So they are making pretty good money every year. So it looks like they make a pretty good net profit. They've been staying above 15. Well, they have a 13 here. So looking at this, I see why they're not growing. It looks like they just barely will grow but it could be due to a lot of different reasons. So I want to look at the balance sheet to see if they have current assets and fixed assets is more than their current liabilities and long-term debt. Because if they owe more in their liabilities, it's not worth for me. They're in a negative net worth. And for me, it's not worth it. So current assets is $11 billion, fixed assets 178. So they have 189 billion in assets, and they're in 72 long-term debt, 72 billion, and current liabilities 25 billion. Now 72 plus, yeah, they're in a positive on this. So quickly, I looked at it, and it does look like they're in a positive net worth. Now, let's see what their free cash flow is. That is interesting. Their free cash flow grew by $3 billion, meaning they had $3 billion extra this year from 2023. But 2022, they're in a negative cash flow. Maybe they did a major investment, major upgrade for the infrastructure, and they used all their cash, but that doesn't look too good for if they have a negative year in 2022. So they have positive cash flow from the year before. So financially, they look stable. They can handle their own money, so it's not that bad. See, operation margin, net margin, return on investment 7.89. Let's see what the company says. Anyone? Okay, so they have quite a few people selling. Well, Charles or Charlie, whatever he wants to call, I really don't see him on here. But they are an electric utility company out of Florida. So let's see what AI says about it. Because right now, I think the earnings is okay. And it looks like they have a good growth opportunity for energy because more and more people is going to need it. But at the end of the day, let's see what the overall AI says about it. So AI says the valuation is 1 out of 6. So it's worth more. Why does they think the valuation? If you want to look at why I like to use MSN, it's because they tell us why they don't get a 6-star or anything like that. And this is why I like using AI. It helps me do my due diligence. Instead of going through a bunch of websites and trying to figure out what the company is, I use AI to summarize it for me. And I like doing that because it saves me a bunch of time. Let's see. Underperformed the coverage shortage. Net profit grew below peer average. Forecast 12 months target. PE multiple industry average. Okay. So it looks like it's an underperforming stock. That's why the valuation is low. The earning is 4 out of 6. Their gross profit margin is pretty good. So I see that. The future growth is 5 out of 6. Now, I don't really agree with this future growth. I think they're speculating that we're going to transfer to green energy just because the AI. Historical performance is 4 out of 6. I can see that. And financial health is 1 out of 6. I can see why the financial health is 1 out of 6. They're not very stable with their cash flow. They have good years, down years. And I like to see a cash flow to stay even or slowly increase. So I know that they're not overspending. But hey, that's what I think. Now let's see what they do compared to peer average for PE ratio. Now peer average is 20.7. They're at 26.77%. And this is why, okay, that makes sense. So the valuation is because they're above what the competitors are at. Price to sell versus peer is 5.84%. Okay, so they're higher than their peer average. And the analyst says to buy this stock. Okay, I'm going to tell already, based off of this growth history that I see right here, and the finances, where they're increase, drop down, and they're not very stable on their revenue on their sell portion. So I don't say this is a buy, because if I look at the finance and look at the revenue growth, it doesn't slowly increase. So what you're going to get is these years that it's going to be going up and down, because the valuation of the company is based off the company's worth. And this is the thing. You're buying a company, and I want to make sure everyone knows, if you're going to buy a company, you need to make sure that you buy a company that is actually worth something and actually has a good leadership with a good plan for their revenue. The good leadership will show you a positive trend with their revenue, a slowly increase, or major increase if they did really well. You shouldn't have this up and down, and that could be to many different reasons. So let's keep looking at this. Future growth, they forecast it to be the industry standard at 10.16. Peer is 0.12, and they have a 2.19. And Duke Energy is beating them, and Dominion Energy is beating them. So what do I think about this? So what do I think about NextEra Energy Inc., ticker symbol NEE? Well, I'm going to say right now, I love the idea that they're doing renewable energy. But based off my opinion of the stock, the growth opportunity, even though AI said it's 5 out of 6, I don't really agree with the growth opportunity due to what I see in their books. So due to the fact that revenue did increase year over year from 2017 to 2024, but decreased from 2023 to 2024. I'm not going to buy them until I see that they have an increase again. Now, if they increase it from 2023, 2024, and this upcoming 2025, yeah, I would buy them, because they had a slow increase year over year. And that's the reason why I'm not going to buy them, because last year they did $4 billion less than the previous year. So it makes no sense for me to buy them. They do have a good profit margin, and they do have a good dividend payout. But me looking at the finances or the books of their sales, it just makes no sense for me to go to a company that lost sales last year. I'm not into getting into a business that they're losing sales. And this year, I can look into their current market, how they're doing, if they hit all their points. But I just don't want to do that. It's just right now it shows me that they're not in a positive. Now, yes, you can go in and go in deeper. I don't like doing that. I like doing the very minimum, and this is my opinion. So personally, I will not be adding this to my dividend portfolio, just because the dividend is a 3.17 and they had a good dividend growth year over year. Doesn't mean they're worth it, because the value of the stock could go down. And what's the point of the value of the stock go down by 1.76% year to year, or in the 1 year, and you get a 3.17? That means you only profit about a 2% growth of that stock. That makes no sense for me to own a stock for that. I'm looking for a good growth opportunity. And when I factor all that in, it makes no sense to buy this stock. Now, I might revisit this stock at the end of the year or next year, just so I can see how they're doing, because I do want to get some renewable energy and some energy companies in my dividend portfolio. It's just this one, does not meet my criteria. So like and subscribe to my video, and that's all I got for you.